They say that more than 90% of people never making in trading and give up. But after 4 years of consistently losing money and blowing accounts, I finally started to make consistently 6 figures from the markets. When I first started with trading, I was completely lost. I didn't have the real guidance and I pretty much needed to build my strategy from zero. Then after I built my strategy, I needed to have complete system on how to scale it to 20 or 30k per month on average. So my goal of this video is gonna be, by the end you will know exactly how I did this, you will know the exact strategy and all the systems that I used, and if you are really serious about trading, just watch till the end, don't skip, take notes and change your life forever. So if you want to become profitable day trader, it all comes down to 2 main factors. First one, it's gonna be average risk to reward, which means when you enter the trade, what are you targeting? So you can see we have here marked out 1 risk to reward, 2 and 3, which means if you are risking, let's say $100 and your entry is gonna be here, if these trades goes towards the stop loss, you're gonna lose $100. But if it goes to take profit, let's say 1 hour, you're gonna make $100. But if your take profit is all the way up here, that means that you're gonna make 1 to 3 risk to reward and you're gonna make $300 if you risk $100. Of course, it's way better feeling when you make more money with risking less money when it comes to trading, but we have one problem. This over here is risk to reward table, which is gonna be the second main pillar. So chances of market hitting 1 risk to reward rather than let's say 3, 4 or 5 are way more possible, because market is usually gonna move like this. We are gonna have, let's say, higher high, higher low, and then we're gonna sweep the liquidity, retrace, then make new higher highs, and you already know. So market is all the time rebalancing the price. So if you want to become profitable, you need to understand this table over here. So if you are targeting, let's say 1 to 1, you need to have at least 60% win rate to be profitable, which means you need to win more trades than you lose. Then we have 1 to 2, you need only 40% win rate in order to become profitable, and you can lose more than you actually win, because your profit factor is gonna be bigger. And then if you look to 1 to 5 risk to reward, you can see that you only need 20% win rate in order to become profitable. So if you are building your own strategy, you just need to understand what to target and what is your win rate, and then you know if you are profitable or not. So after that, we need to build simple trading strategy, and this strategy that I'm about to show you, it's completely rules based model, which means it is easy to follow and execute, and you don't need to include any emotions because, like I said, we have rules in place. It is also repeatable and proven to work because I backtested the last 10 years of live market, and the best part is that you only need 60 to 90 minutes a day, because we trade for freedom. We don't want to be on charts 24/7, we don't want to 9 to 5 charts, we only need 60 to 90 minutes in order to catch a winning position. You can see also over here my profits from using this model, and I made almost $30,000 in just 1 single month with almost 90% win rate. As you can see, when I say that we are trading 60 to 90 minutes per day, I don't mean that we are gonna take a trade every single day. You can see there are a lot of weeks where I take only 1 trade, but that 1 trade is winning position and I don't care. So we are not forcing any trades, and this is how we are gonna keep insanely high win rate. So now the only question that we have is how you're gonna do the same. So the strategy that we're gonna use is gonna be called SCM. S is gonna stand for structure, C is gonna stand for correction, and M it's gonna be for manipulation. So we're gonna have 3 simple steps. Starting from the step number 1, it's gonna be for us to identify the market direction. This is gonna be the structure phase. So market is either moving to the upside, so let's say higher high, higher low, higher high, or market is trading to the downside, let's say lower low, lower high, and lower low. The only difference that market is over here breaking structure to the upside, but over here we are breaking structure to the downside. That is the only difference. And also we have consolidation phase. This is where market is not breaking structure to the upside or downside, and in these market conditions we are just simply waiting for the breakout, so we are not trading in it. In this example over here, you can see that we are making higher highs, retracing higher lows, then again higher highs, retracing, and then again higher highs. So for the step number 1, we identified that market is clearly bullish, which means we are trading to the upside. Then we have step number 2, which is going to be correction phase. Here is where we are going to identify the key liquidity levels. So every single time when market makes higher highs and then retraces, we're going to leave liquidity here. Then we are going to have again higher high, higher low. Liquidity is going to be resting here. Then again, we are breaking structure to the upside, but still liquidity is resting underneath these lows, which means a lot of money is resting here in the market, and simply market needs to take out all of those orders and then continue the move to the upside. So you can see over here, we made a move to the upside, then we have correction, liquidity was resting here, market took out this liquidity and then move again to the upside. What are we gonna do right now? We have again correction, liquidity is resting, and when market is ready, we are gonna sweep this liquidity and then continue the rally to the upside. And as you can see, that is exactly what happened. And on the lower time frame, you're gonna see manipulations and entry model, and that is gonna be the last step, which is gonna be step number 3. We're gonna wait for liquidity grab, and then on the lower time frame, we're gonna catch a trade here by using inversion of the fair value gap. And also you can see we have here bullish fair value gap that is also holding the price, which is one more confluence. So you can also see the lower time frame entry example. So let's say over here we have liquidity sweep inside of bullish fair value gap, and if market is truly bearish after we sweep the liquidity, which is not going to be the case, you can see that market is going to leave the bearish fair value gap on the lower time frame. And if we are bearish, market is going to come here, retest this fair value gap, and then continue the move to the downside and break the structure. But after we already took out all the liquidity, took out all the money from the market, what is market gonna do next? We're gonna inverse or disrespect this fair value gap and then just target the opposite liquidity. It's simple as that. So you don't need to predict or guess where the market is gonna move, we are simply reacting. And the last step, it's gonna be execute your trade, which is gonna be where to place your stop loss and take profit. This is the easiest one, and stop loss is always gonna go either to the low of the candle or the inversion of the fair value gap, and take profit is gonna be always fixed risk to reward or aim for the opposite liquidity. And that is all you need to know. And the reason why I love this strategy so much is because it works across trending markets and reversal opportunities. So if market is trending to one direction, you can make money, and when market is reversing, you can also make money. So this over here is bullish direction, and as you can see, we are retesting the bullish fair value gaps, sweeping liquidity, and then continuing the direction. So I'm gonna show you how to catch every single trade here and then ride this move. And this example over here, it's gonna be when market is ranging. So we are gonna just mark out the highest high of this range and the lowest low of this range, and then we are gonna either wait for the breakout, retest, and then continuation, or the sweep of liquidity, let's say a sweep of the highs, then inversion of the fair value gap, and then we're going to continue and target the opposite liquidity levels. It is really simple, and don't worry if you don't understand this 100%. I'm also going to show the live trade examples. So let me show you the one example of the ranging markets. First, when you come to the charts, we're going to mark key liquidity levels. So this is going to be the highest high of this entire range, and let's say this is going to be the lowest low of this entire range, and also I call this a box. So we are not gonna trade inside of this because you can see price is not efficient, you don't even know where the market is gonna go to, so we are simply gonna wait for one side to be taken out. And then look what happened, manipulation on the one side, so we finally took out the buy side liquidity. And now the problem that we have, it's gonna be that a lot of traders are gonna see this as some sort of break of structure or continuation to the upside, which is completely wrong, and this is the exact reason why everybody is losing money in the markets. So if you saw this is a break of structure, you can see that you immediately got your stop loss, because this was not break of structure. Like I said, this was just manipulation, and the market took out all the buy side liquidity, and now we are gonna target all the sell side liquidity. And most of the times you're gonna have on the lower time frame fair value gap, which is gonna show you the overall direction, and this is gonna be your entry model. And this is how it played out at the end without any drawdown. So you can also see my results over here where I had almost 80% win rate, and this is how much money I made across the last 6 months. So now the next question is how you can start or how you can scale if you are already profitable trader. And the answer is gonna be in prop firms, because skill is gonna give you the access to the capital. So what are essentially the 3 main steps when it comes to prop firms? First, you need to choose what firm you're gonna buy account, and then once you buy account, you pass trading evaluation challenge, and then you are funded and you are already on the step number 2. You're gonna get access to a funded account, and then once you start to trade it, every single time that you take a trade and you make some profits, you're gonna keep 80 to 100% to yourself. And that is literally all you need to know. So if you are profitable, you're gonna make money. If you are not profitable, you are not gonna make money. And this is gonna be the blueprint how you're gonna scale after you already become profitable trader. So let's say if you have one prop firm account and on first trade you make $500, second one the same, third one the same, that means that 3 wins equal to 1.5k, and if you request a payout you can receive 1.5k. But then if you want to make $30,000 with doing the exact same thing, just instead of one prop firm account you're gonna have 20 prop firm accounts, and then first trade it's gonna be multiplied by 20 and you're gonna make the $10,000. Then on the second trade we did the exact same thing as before, but we just multiplied this by 20, and then by the third win you have $30,000 available to request. And this is the exact blueprint on how you can scale and do the same thing. So right now we're gonna go on the live charts and I'm gonna show you some real trade examples. Okay, so the first example is gonna be on the trending market. So you can see that we are bullish over here. Why is that? Simply because we are making higher highs, correction higher lows, then again higher highs, correction higher lows, and we are anticipating that market is gonna make new higher high. So one thing that you need to keep in mind, if this was higher high and this was the actual correction over here, that means that liquidity is resting underneath this low. So even if we scale to the, let's say, lower time frame 15 minute, you can see that this is the main key liquidity low and this is gonna be the opposite high. But just because we are bullish, we are anticipating that market is first gonna sweep this low and then continue the trend to the upside. So this is gonna be my bias for this certain day. And also this is gonna be one of the most important things. We're gonna trade from 9:30 till 11 or 12, because like I said, we're gonna only trade 60 to 90 minutes per day. And this is where the market actually opens, New York Stock Exchange, and this is where the most volume kicks in. So what I'm gonna do, I'm just gonna skip the price, and here you go. This is 9:30. And now most of the traders think that this is going to be the bearish sign, that market is ready to reverse or whatsoever, but that is not the case, because this was just simply sweep of liquidity. As you can see, market never broke the structure, and even if you go on the lower time frame, probably most of the traders are gonna see this as, let's say, this is gonna be the lower high, lower low. They're gonna see this as a breakout structure. They're gonna see this as a bearish fair value gap, and guess what they are gonna do? They're gonna take their short position, put their stop loss above, and they are gonna target the opposite liquidity. And if you play the price, you can see what happens. Immediately stop loss, because this is not how the market moves. So if we repeat this one more time, if we already took out liquidity and from the hard time frame we are rebalancing the price and we are respecting the hard time frame bullish fair value gaps, what we're gonna do on the lower time frame, we are simply gonna wait for this fair value gap to be inversed, and then we're gonna take a trade. So here you go, this is not inversion, this is just weak above this fair value gap. Now we need to wait, and here you go, this is the inversion and you can place a trade. So our entry is always gonna be on the closure of the candle, and we're gonna put stop loss, like I said, below that inversion or the last candle, let's say like this, and then we're gonna simply target fixed risk to reward, let's say 1 to 1, 1 to 2, or you can target the opposite liquidity, which is gonna be this high. Now I'm gonna play this to see if this is gonna work out, and here you go. If you didn't go break even, it worked out. And this is why I said that usually most of the time 1-to-1 is always gonna get hit, and this is how you're gonna have insanely high win rate. But if you are aiming to target, let's say 1-to-2, or even something more from 1-to-2, 1-to-3, 1-to-4, it's most likely that market is gonna come to first take profit, and then it's gonna stop you out at break even or at a loss. So the way I like to approach the market, it's gonna be that I always target, let's say 1-to-1, but I have insanely high win rate, and that's why I don't need to target 1-to-2 or the opposite liquidity, because I'm insanely profitable with targeting little risk to rewards. So that is just my approach, but at the end everything is gonna work out if you backtest the results by yourself. And maybe if you missed the first trade, you can see after we made a retracement, we still didn't take out this last high, but what we did over here, we have another inversion of the fair value gap. So you can place a trade here, long position, put your stop loss below, and you can target the opposite liquidity, which is gonna be at the same time 1-to-1. And let's see if we extend this for, let's say 1-to-2, is this actually gonna play out or not? And almost, and as you can see, it didn't play out. So this is why it's very important to understand whether you're gonna target high risk to reward or you're gonna aim for higher win rate. So you can see how someone with the same strategy that is proven to work can be unprofitable, because if you are targeting insanely high risk to rewards, that is just impossible to hit all the time. Of course, sometimes it is gonna get hit, but most of the time it's not gonna get hit. So what I would suggest you, especially as a beginner, if you are starting out, just aim for the less risk to reward. And here we go, this is gonna be the second example. This is gonna be when we don't have any bias, when market is not trading, but we are simply gonna mark out the highest high of the range, and we are gonna mark out the lowest low of the range, and this range is gonna become our box. So right now what we are gonna do, we are gonna either wait for the breakout below this range, retest and continue direction, or we're gonna wait for the sweep of liquidity like this, and then inversion of the fair value gap and target the opposite side. It is always the same thing, repeating over and over again. So this is 9:30, as you can see on the lower time frame, that is nothing going on. So we are just gonna play the price to see if this is gonna work out. And also keep in mind, we have two bearish fair value gaps, and here we go, we have the sweep of liquidity, which is the sweep of this range. Right now we can look for longs. So we have one fair value gap and we have the second one over here. So if I want to take longs, I need to see all these fair value gaps getting inversed, because if only one of those gets inversed and one is not inversed, that means that most likely your trade is gonna lose, and you're gonna see exactly why. And here you go, you can see this bearish fair value gap gave a bounce here and you got your stop loss. So you always need to wait for all the inversions in the leg to be inversed. So this is just one tip how you can easily avoid a loss. So right now we're gonna play the price, and here we go, we have another sweep of liquidity, another manipulation, which is gonna be the final manipulation. And also over here, what do we have? We have singular fair value gap. So on the 3 minutes it is the same fair value gap, on the 2 minutes we don't have any fair value gaps, and on the 1 minute we don't have any fair value gaps. So it is singular and it is one and only. So after you see this, you can place your trade immediately, put your stop loss below the last candle, and again the same process, you can target either the opposite liquidity or fixed 1-to-1 or 1-to-2. So let's see if I play the price, how this is gonna play out. And here you go, in this example over here, it played out all towards to the opposite liquidity. So like I said, sometimes it is gonna play out, sometimes it is not. But one thing is for sure, if you only target 1-to-1, chances that your trade is gonna play out in your favor are extremely high. And as you can see, if you targeted something extremely high, let's say 1-to-5, and you didn't take any partials, any profits, you would end up losing on this trade, while it could be a winner. So essentially that's gonna be it for this video. I really hope that you enjoyed, because I showed you my entire strategy, my whole system on how to scale, how to use it every single day. And if you really enjoyed this video, just smash that subscribe, like the video, and I'm gonna see you in the next one. Peace.